I am about to tell you something that Wall Street does not want you to hear. Something that the Federal Reserve is desperately hoping does not happen. Something that could trigger the next financial crisis and wipe out trillions of dollars in wealth. The American consumer is about to break, and when they break, everything breaks with them. I have been studying the data obsessively for months. Credit card balances, auto loan delinquencies, buy now, pay later defaults, savings rates, wage growth versus inflation, debt service ratios, every piece of consumer financial data I can get my hands on. And what I see terrifies me. We are approaching a cliff. The consumer credit collapse starts in 2026, maybe late 2025 if things accelerate. But it is coming. The math is undeniable. You probably remember me from The Big Short. I was the guy who saw the housing crisis coming years before it happened. I bet against mortgage-backed securities when everyone thought I was insane. My investors tried to pull their money, my reputation was destroyed, and then I was proven right. The system collapsed exactly as I predicted. I am seeing the same patterns, now different asset class, different mechanism, but the same fundamental dynamic debt that cannot be repaid, risks that are being ignored. A system that depends on optimistic assumptions that will not hold. And when those assumptions fail, the cascade begins. Let me walk you through exactly what I am seeing and why I believe 2026 is when the consumer credit system begins to crack. The first thing you need to understand is where the American consumer stands right now. During the pandemic, something unusual happened. Consumers accumulated excess savings, stimulus checks, enhanced unemployment benefits, reduced spending on travel and entertainment. Americans built up over $2 trillion in excess savings above normal trends. This savings cushion allowed consumers to keep spending even as inflation exploded in 2021 and 2022. Prices went up 30, 40, 50% on many goods, but consumers kept buying because they had a buffer. They could absorb the higher prices without immediately changing their behavior. That cushion is now gone. The excess savings have been depleted. Every study, every analysis, every data point confirms this. The average American household no longer has that pandemic buffer. They are back to living paycheck to paycheck. Actually, they are worse than paycheck to paycheck because they accumulated debt to maintain their lifestyle as the savings ran out. Credit card balances have exploded to over $1.1 trillion. That is the highest level in American history. Average credit card interest rates are now over 20%. 20%. Think about what that means. If you carry a $10,000 balance, you are paying $2,000 a year just in interest. That is money that is not going to groceries or rent or anything productive. It is just servicing debt. Auto loans have ballooned to over $1.6 trillion. The average new car payment is now over $700 per month. The average used car payment is over $500. These are record levels. People are financing cars over 7 and 8 years just to make the monthly payments affordable. They are underwater on their vehicles the moment they drive off the lot, and they stay underwater for years. Buy now, pay later has exploded from essentially nothing to tens of billions in outstanding balances. This is debt that does not even show up on traditional credit reports. People are using buy now, pay later to finance groceries, to finance gas, to finance everyday purchases they cannot actually afford. This is desperation borrowing disguised as a convenient payment option. Student loans are back in repayment after years of pandemic forbearance. 43 million borrowers now have to start making payments again on $1.7 trillion in student debt. Many of these borrowers have not made a payment in over 3 years. They got used to that money being available for other things. Now it is gone, add it all up, and you have consumers who are stretched to the absolute limit. Savings gone, debt at record levels. Interest rates at 20-year highs, and now they have to start repaying student loans on top of everything else. This is not sustainable. Something has to give. And when consumers can no longer service their debts, the defaults begin. Let me show you the early warning signs I am already seeing in the data. Credit card delinquencies are rising rapidly. The percentage of credit card balances that are 90 or more days past due has increased significantly over the past 2 years. It is not yet at crisis levels, but the trajectory is alarming. The rate of increase is actually faster than it was in the lead-up to 2008. Auto loan delinquencies are even worse. Subprime auto loans, those made to borrowers with credit scores below 620, are defaulting at rates that exceed the 2008 crisis. Let me say that again. Subprime auto defaults are already worse than 2008. This is not a prediction, this is current reality. The reason you have not heard more about this is that prime borrowers, those with good credit, are still performing reasonably well. The overall default rate looks manageable because the prime loans are averaging down the subprime disaster. But the subprime defaults are a leading indicator. These are the most stressed borrowers, the canaries in the coal mine. When they start failing in large numbers, it tells you that pressure is building throughout the system. But we now pay later default rates are shocking. Some providers are seeing default rates of 15–20% or higher. This form of credit expanded so rapidly during the pandemic that underwriting standards were essentially non-existent. Anyone could get approved. Now those chickens are coming home to roost. Student loan delinquencies are just beginning to show up in the data as the repayment pause ends. Early numbers suggest that a significant percentage of borrowers are simply not making payments. Some cannot afford to. Others have gotten used to not paying and are not willing to resume. The Department of Education is struggling to process the administrative challenges of restarting a system that was paused for 3 years. Here is the critical point. All of these stresses are happening while unemployment is still low. The labor market has remained remarkably strong despite all the predictions of recession. People still have jobs. They are still earning paychecks. And yet they are already falling behind on their debts. What happens when unemployment rises? What happens when we actually have a recession? If consumers are struggling to make payments now, with jobs, what happens when they lose those jobs? This is the dynamic that leads to collapse. The stress builds gradually, then releases suddenly. Right now we are in the gradual building phase. Delinquencies rising, savings depleting, debt accumulating, but the system is still functioning because most people are still employed and still making some payments. 2026 is when I expect the sudden release. Here is my reasoning. The Federal Reserve has raised interest rates to the highest levels in over 20 years. These rate hikes work with a lag. It takes 12 to 18 months for the full impact of rate increases to flow through the economy. The Fed's most aggressive hikes were in 2022 and 2023. The full impact of those hikes is still being felt. Higher rates affect consumers through multiple channels. Credit card rates adjust quickly, and we are already seeing the impact. Mortgage rates affect anyone buying a home or refinancing. Auto loan rates have increased significantly. Business borrowing costs rise, which eventually affects hiring and wages. The corporate debt refinancing wall hits in 2025 and 2026. Trillions of dollars in corporate bonds issued during the low-rate era need to be refinanced at much higher rates. Some companies will not be able to afford the higher payments. They will cut costs, which means layoffs. They will reduce investment. Some will fail entirely. Commercial real estate is already in crisis. Office buildings are worth a fraction of what they were before the pandemic. Retail properties are struggling. Even apartment buildings face pressure as rent growth stalls. The loans on these properties come due over the next few years. Many will default. Banks holding these loans will take losses. All of these forces converge in 2025 and 2026. Higher rates flowing through the system. Corporate refinancing stress leading to layoffs. Commercial real estate defaults hitting bank balance sheets. And consumers who are already stretched to the breaking point when unemployment starts rising. Even modestly, the consumer credit system will crack. People who are barely making payments now will stop making payments entirely when they lose their jobs. Default rates will spike. Lenders will tighten credit standards, making it harder for consumers to borrow. Spending will collapse. More businesses will struggle. More layoffs will follow. The feedback loop accelerates. This is exactly what happened in 2008 with housing subprime mortgages. Started defaulting, lenders tightened standards, home prices stopped rising and started falling. More mortgages went underwater, more defaults, more tightening. The spiral fed on itself until the entire system collapsed. The consumer credit market in 2026 will follow a similar pattern. The trigger will probably be a rise in unemployment, but it could be anything that pushes marginal borrowers over the edge. A spike in gas prices, a stock market decline that destroys household wealth, a geopolitical shock that causes economic uncertainty. The system is so fragile that many different triggers could set off the cascade. Let me explain why this matters beyond just credit card losses and auto repossessions. Consumer spending is 70% of the American economy. 70% when consumers stop spending. The entire economy contracts. Businesses lose revenue. They lay off workers. Those workers stop spending, more businesses lose revenue. The recession feeds on itself. In a consumer credit collapse, the contraction is particularly severe because consumers do not just reduce spending. They actively pay down debt. Every dollar used to pay down debt is a dollar not spent in the economy. This is what happened after 2008. Consumers spent years deleveraging, paying down mortgages and credit cards. Economic growth was anemic for years as a result. If we have a consumer credit collapse in 2026, expect a deep recession, not a shallow dip, not a soft landing. A real contraction that lasts multiple years as consumers repair their balance sheets. The stock market implications are severe. Corporate earnings depend on consumer spending. When consumers retrench, earnings collapse, stock prices follow. The last two major recessions saw stock market declines of 50% or more. A consumer-led recession in 2026 could easily produce similar losses. The financial system faces significant risk. Banks hold consumer loans directly and through securities. Credit card losses, auto loan losses, personal loan losses all hit bank earnings and capital. If losses are severe enough, some banks could fail. We already saw regional bank failures in 2023. A consumer credit crisis would put far more institutions at risk. The Federal Reserve will face an impossible choice. Cut rates to support the economy and risk reigniting inflation. Keep rates high and watch the credit system collapse. There is no good option. Whatever they do, the pain is coming. Now let me tell you what I am doing to prepare. Because understanding the problem is useless if you do not position yourself to survive it. First, I am avoiding consumer-facing businesses in my portfolio, retailers, restaurants, travel companies, consumer discretionary of all kinds. These will be decimated when consumers retrench. It does not matter how well managed the company is or how cheap the stock looks. If your customers stop spending, your business collapses. Second, I am avoiding banks with heavy consumer loan exposure, credit card issuers, auto lenders, consumer finance companies. When defaults spike, these businesses take massive losses. Some will fail. I do not want to own them when that happens. Third, I am building positions in businesses that benefit from distress. Debt collectors will see volumes explode. Discount retailers will gain share as consumers trade down. Companies that help businesses cut costs will thrive. Bankruptcy lawyers and restructuring advisors will be busy. These are not pretty businesses, but they prosper when others suffer. Fourth, I am maintaining substantial cash reserves. When the crisis hits, asset prices will collapse. Cash will be king. The opportunity to buy quality assets at distressed prices only comes to those who have liquidity when everyone else is desperate. I want to be a buyer when everyone else is selling. Fifth, I am short certain consumer credit exposed securities. I will not get into specifics because my positions are proprietary. But there are ways to profit directly from consumer credit deterioration. Shorting consumer finance stocks. Buying puts on consumer discretionary ETFs, credit default swaps on certain asset-backed securities. These are sophisticated strategies with significant risk, but they provide direct exposure to the thesis. Let me also talk about what this means for ordinary people who are not managing hedge fund portfolios, because the coming consumer credit collapse will affect everyone, not just investors. If you have credit card debt, pay it down now, aggressively. 20% interest rates are wealth destroyers. Every month you carry a balance, you are digging a deeper hole. Cut expenses, take a second job, sell things you do not need, get that debt paid off before the crisis hits. If you have an auto loan with high payments, Consider whether you can downgrade to a cheaper vehicle. A $700 monthly car payment is a luxury most people cannot actually afford. Sell the expensive car, buy something reliable and cheap. Use the savings to build an emergency fund or pay down other debt. If you are living paycheck to paycheck with no savings, you are extremely vulnerable when the layoffs come, and they will come. You need a cushion, 3 months of expenses at minimum. 6 months is better. I know it is hard to save when everything is expensive, but having no savings when a recession hits is a recipe for disaster. If you have student loans, understand what your payment obligations are and plan for them. Do not stick your head in the sand and hope they go away. They will not go away. Missed payments will damage your credit and compound your problems. Make a realistic budget that includes your student loan payment. If you have a stable job, think about how secure it really is. What happens to your company if consumer spending drops 20%? Are you in a division that would be cut? Do you have skills that are in demand regardless of economic conditions? Now is the time to think about career resilience, not after the layoffs have started. If you are thinking about making a major purchase, a house, a car, anything financed, think carefully about whether you can afford it if your income drops or your expenses rise. The people who get destroyed in recessions are those who took on obligations during good times that they cannot maintain during bad times. I am not telling you to panic. I am telling you to prepare. The consumer credit collapse is not happening tomorrow. You have time. Use that time wisely. Let me address some counter-arguments because I know people will push back on this thesis. Some will say the labor market is too strong for a consumer crisis. Unemployment is low. Jobs are plentiful. Wages are rising. How can consumers be in trouble when they have jobs? This argument ignores the math. Wages have risen, but inflation has risen faster. Real wages adjusted for inflation have declined for most workers. They are earning more dollars, but those dollars buy less. Meanwhile, their debt service obligations have increased as rates have risen. The squeeze is real even with employment. And the labor market can change quickly. Every recession begins with low unemployment. That is what makes it a recession. The shift from good conditions to bad. The labor market was strong in early 2008 too. Within a year, unemployment had doubled. Some will say the Federal Reserve will cut rates and bail everyone out. If consumer credit starts collapsing, the Fed will pivot. They will slash rates. They will inject liquidity. Problem solved. This argument underestimates the inflation constraint. The Fed cannot cut rates aggressively while inflation remains above target without risking a resurgence in prices. And even if they do cut, monetary policy works with a lag. It takes time for rate cuts to flow through the system. By the time the Fed responds to a consumer credit crisis, significant damage will already be done. Moreover, rate cuts help borrowers at the margin but do not help borrowers who are already insolvent. If someone has lost their job and cannot make their car payment, a 1% rate cut does not save them. They still default. Some will say consumers are more resilient than I am giving them credit for. Americans have been through tough times before and have always come out, okay? Consumer spending always recovers. This argument ignores the unprecedented nature of the current debt levels. Consumers have never owed this much. Credit card debt has never been this high. Total consumer debt relative to income has never been this elevated. We are in uncharted territory. Historical patterns may not apply. The comparison I keep coming back to is 2008. Then the problem was housing debt. Consumers had borrowed too much against their homes. When home prices stopped rising, the whole structure collapsed. Now the problem is consumer debt more broadly. Credit cards, auto loans, buy now, pay later, student loans. The total is larger, the interest rates are higher, the ability of consumers to service these obligations is more impaired. Some will say I have been wrong before. I am always predicting doom. Even a broken clock is right twice a day. This is fair criticism. I have been cautious for years. The collapse I expected has taken longer to materialize than I anticipated. But my track record on major calls speaks for itself. I was early on housing, but I was right. Being early is not the same as being wrong. And the dynamics I am describing in consumer credit are not speculative. They are visible in current data. The debt levels are real. The delinquencies are real. The stress is real. The only question is timing, and I believe 2020. 6 is when the accumulated stress reaches a breaking point. Let me paint a picture of what the consumer credit collapse might actually look like when it unfolds. It probably starts gradually. Delinquencies continue rising through 2025. Credit card losses increase. Auto repossessions accelerate. Lenders start tightening standards, making it harder for marginal borrowers to get credit. Then something triggers a faster deterioration. Maybe unemployment rises above 5%. Maybe a major retailer or consumer finance company fails. Maybe there is some external shock that destroys consumer confidence. The trigger is hard to predict, but the system is fragile enough that many things could set it off. Once the collapse accelerates, it feeds on itself. More defaults lead to more losses for lenders. More losses lead to tighter credit. Tighter credit means less consumer spending. Less spending means more business failures and layoffs. More layoffs mean more defaults. The spiral intensifies. Consumer spending drops sharply. Retailers see same. Store sales fall 10, 20, 30%. Restaurants empty out. Travel spending collapses. Auto sales crater. Home sales, already depressed, fall further. The stock market anticipates the earnings collapse. Consumer discretionary stocks fall 50, 60%. Banks get crushed as loan losses mount. Even defensive stocks get hit as the recession broadens. The Federal Reserve cuts rates aggressively, but it takes time to have an effect. The cutting starts too late and initially seems ineffective. Panic spreads, credit markets freeze, corporate bond spreads blow out. Companies that need to refinance cannot. Bankruptcy filings surge. Unemployment rises through 2026 into 2027. It peaks somewhere in the range of 8 to 10%, maybe higher if the collapse is severe. Millions of jobs are lost. The government responds with fiscal stimulus, but the political process is slow and contentious. By the time significant stimulus is enacted, the damage is done. Eventually, the system stabilizes. Consumers have defaulted on debt they could not pay. The losses have been absorbed. Those who kept their jobs have rebuilt savings. Lending starts to recover. The economy begins to grow again, but the process takes years. Like after 2008, the recovery is slow and uneven. Consumer behavior is permanently changed. A generation of Americans becomes more cautious about debt. The scars last for decades. This is the scenario I am preparing for. Not because I want it to happen, because I believe it is likely to happen. And being prepared for a bad outcome that does not occur is far better than being unprepared for a bad outcome that does. The consumer credit collapse of 2026 is not inevitable. Maybe something changes the trajectory. Maybe the Federal Reserve engineers a true soft landing. Maybe wage growth accelerates and bails out stretched consumers. Maybe I am wrong about the timing and the system can muddle through for longer than I expect. But the probabilities favor stress over stability. The math is not sustainable. Consumers cannot carry this much debt at these interest rates with stagnant real incomes forever. Something has to give. And when it gives, the consequences will be severe. I made my fortune by seeing 2008 coming before others did. I am seeing 2026 the same way. The debt cannot be serviced. The assumptions are unrealistic. The fragility is extreme. The collapse is coming. You have time to prepare. Use it, pay down debt, build savings, reduce expenses, secure your income, position your portfolio defensively. Do not assume that because things have been okay, they will continue to be okay. That assumption has destroyed wealth throughout history. The consumer credit collapse starts in 2026. You have been warned. But let me go deeper because I want you to truly understand the mechanics of how this unfolds. The specific transmission channels matter. They determine who gets hurt, how quickly the damage spreads, and where the opportunities might emerge. The first transmission channel is the credit card securitization market. Most people do not realize that their credit card debt does not stay on the bank's balance sheet. Banks package credit card receivables into securities and sell them to investors. These asset-backed securities are held by pension funds, insurance companies, mutual funds, and other institutional investors. When credit card defaults rise, these securities take losses. The lower-rated tranches get wiped out first. Then the losses climb up to higher-rated tranches. Investors who thought they owned safe investment-grade securities discover they own paper backed by defaulted consumer debt. This creates forced selling. Many institutional investors have mandates that require them to sell securities that fall below investment grade. When downgrades happen, they have to sell regardless of price. This drives prices down further, creates more losses, and triggers more selling. The feedback loop accelerates. I saw exactly this dynamic in 2008 with mortgage-backed securities. Securities that were rated AAA turned out to be worthless. The ratings agencies had completely failed to assess the risk. Investors who trusted those ratings lost fortunes. The same thing will happen with credit card securities. The ratings on these instruments assume default rates that are far too optimistic. When actual defaults exceed the models, the securities will be downgraded. Forced selling will begin. Prices will collapse. Losses will spread far beyond the original lenders. The second transmission channel is the auto loan market. Auto loans have been packaged into securities even more aggressively than credit cards. Subprime auto loans in particular have been bundled and sold to yield-hungry investors. The subprime auto market is already in crisis. Default rates are elevated. Recovery rates on repossessed vehicles have fallen because used car prices have declined from their pandemic peaks. Lenders are losing more money per default than they expected. When subprime auto securities start taking serious losses, the effects ripple through the financial system. Hedge funds that bought these securities on leverage will face margin calls. They will sell other assets to meet those calls. Prices of unrelated securities fall. The contagion spreads. Auto lenders will pull back from subprime lending entirely. People with impaired credit will not be able to buy cars. Auto sales will collapse. Auto manufacturers will struggle. Their suppliers will struggle. Layoffs will follow throughout the automotive supply chain. The third transmission channel is the buy, now pay later ecosystem. This is newer and less understood, which makes it more dangerous. Buy now pay later companies extended credit rapidly without building the infrastructure or reserves to handle significant defaults. Many buy now pay later providers are not profitable even in good times. They have been burning venture capital money to grow. When defaults spike, their losses will explode. They will not have the capital to absorb the losses. Some will fail entirely. When buy now pay later providers fail, the merchants who relied on them will be affected. Many retailers have become dependent on buy now pay later to close sales. Customers who cannot pay upfront use buy now pay later to complete purchases they otherwise could not afford. When that option disappears, retail sales will fall. The fourth transmission channel is the banking system. Small and regional banks have significant exposure to consumer loans. They do not have the diversification of the mega banks. A spike in consumer defaults could threaten their solvency. We already saw how quickly confidence in regional banks can collapse. Silicon Valley Bank went from functioning normally to seized by regulators in less than a week. First Republic followed shortly after. The deposit insurance system was stressed. The Federal Reserve had to create emergency lending facilities. A consumer credit crisis would put far more banks at risk. Credit unions with heavy consumer lending, community banks in regions with high unemployment. Regional banks that concentrated in auto lending or credit cards. The banking system is not as resilient as regulators want you to believe. Bank failures create their own contagion. When one bank fails, depositors at other banks get nervous. They move money to larger, safer institutions. This drains deposits from smaller banks, weakening them further. The cycle of confidence loss spreads. The fifth transmission channel is the employment market itself. Consumer spending supports millions of jobs in retail, hospitality, entertainment, and other sectors. When consumers retrench, these industries cut jobs. Job losses reduce income. Reduced income means more defaults and less spending. More businesses suffer, more jobs are cut. The recessionary spiral deepens. The unemployment rate is a lagging indicator. By the time unemployment rises significantly, the damage is already severe. Companies wait until they absolutely have to cut before reducing headcount when they finally do. It is a sign that conditions have been deteriorating for months. This is why I focus on leading indicators like credit card delinquencies and subprime auto defaults. These tell me what is happening now. Not what happened last quarter. They show stress building before it manifests in headline unemployment numbers. Let me also discuss the geographic dimension of the coming crisis. The pain will not be distributed evenly across the country. Areas with high concentrations of subprime borrowers will be hit hardest. These tend to be lower-income areas, both urban and rural communities, where household incomes are modest and debt burdens are high relative to income. Areas dependent on consumer spending industries will suffer disproportionately. Tourism destinations, shopping centers, entertainment districts, the jobs in these areas will disappear. Areas with heavy exposure to auto manufacturing will face a double hit. Consumer retrenchment will crush auto sales. Auto industry layoffs will devastate local economies. Think of Michigan, Ohio, Indiana. These states could see unemployment rates far above the national average. Coastal cities with high costs of living present a different kind of vulnerability. Workers in these areas have stretched to afford housing. Many are carrying credit card balances because their incomes do not cover their expenses. When layoffs hit, they will default quickly because they have no cushion. The housing market will be affected even though this is not primarily a housing crisis. When people default on credit cards and auto loans, their credit scores collapse. They cannot buy homes. First-time buyers disappear from the market. Home sales fall. Prices eventually follow. Homeowners who lose their jobs may have to sell their homes. Foreclosures will rise, though probably not to 2008 levels since mortgage underwriting has been tighter. Still, housing will be a source of additional pain rather than a buffer against the consumer credit collapse. Let me talk about timing in more detail, because timing matters enormously for how you position yourself. I said 2026 is when the collapse accelerates, but there are scenarios where it could happen sooner or later. A sooner scenario would involve some external shock that pushes marginal consumers over the edge before the organic deterioration reaches a critical point. A geopolitical crisis that spikes oil prices, a stock market crash that destroys household wealth, a major corporate failure that triggers a confidence crisis. Any of these could accelerate the timeline to late 2025. A later scenario would involve the Federal Reserve cutting rates aggressively and successfully extending the cycle. If they pivot quickly and rates fall significantly, some borrowers who would have defaulted will be able to hang on. The crisis would be delayed, though probably not prevented. The debt would still be there. The fundamental math would still not work, but the timing could shift to 2027 or beyond. The most likely scenario in my assessment is that the crisis begins in earnest in 2026. The stress is already building. The Fed is not cutting fast enough to relieve it. Unemployment will eventually rise, and when it does, the accumulated stress will release. I want to also address the policy response because it will determine how severe and prolonged the crisis becomes. The Federal Reserve will cut rates. That is certain. The question is how quickly and by how much. If they are aggressive, cutting rates by 2 or 3 percentage points rapidly, they can cushion the blow. If they are cautious, worried about reigniting inflation, the crisis will be worse. Based on recent behavior, I expect the Fed to be too slow. They were too slow to raise rates when inflation emerged. They will probably be too slow to cut when the economy weakens. They are fighting the last war, worried about inflation when they should be worried about deflation and depression. Fiscal policy is harder to predict because it requires political consensus. In theory, the government could provide stimulus to cushion consumer balance sheets, expanded unemployment benefits, direct payments, debt relief programs, but passing such measures requires Congress to agree, which is difficult in a polarized environment. I expect the fiscal response to be too little, too late. By the time politicians agree that action is needed, the crisis will be well underway. The stimulus will help the recovery, but will not prevent the initial damage. Bank bailouts are likely if the crisis is severe enough. The government will not let the banking system collapse. But bailouts are politically unpopular. They may come with conditions that limit their effectiveness, and they will not arrive until the crisis is already acute. The bottom line on policy is that you should not count on the government to save you. They will eventually respond, but not quickly enough to prevent significant pain. You need to protect yourself. Let me give you some specific metrics to watch as indicators of whether the crisis is approaching. Watch credit card delinquency rates. If the 90-day delinquency rate crosses 3% and keeps rising, the crisis is accelerating. Currently, it is heading in that direction but has not crossed that threshold. Watch subprime auto delinquency rates. These are already elevated. If they exceed 6% on a sustained basis, expect widespread lender losses and credit tightening. Watch consumer confidence surveys. When confidence collapses, spending follows quickly. A sharp drop in the University of Michigan or Conference Board surveys would be a warning sign. Watch retail sales data. When same-store sales turn negative for major retailers, consumers are retrenching. This is a coincident indicator that will confirm the crisis is underway. Watch initial unemployment claims. A sustained rise above 300,000 per week would signal the labor market is weakening. This is often the trigger that turns stress into crisis. Watch bank loan loss provisions. When banks start dramatically increasing their reserves for loan losses, they are seeing deterioration in their portfolios. This is a leading indicator of credit tightening. Watch high-yield bond spreads. When spreads widen sharply, it signals that investors are becoming risk-averse. This affects corporate borrowing costs and eventually employment. I check these indicators constantly. They tell me where we are in the cycle. Right now, many of them are flashing yellow, not yet red, but heading in that direction when they turn red. When multiple indicators simultaneously signal distress, that is when the crisis is imminent. That is when you need to be fully positioned defensively. That is when opportunities to buy distressed assets will begin to emerge. I hope I am wrong about all of this. I hope the Federal Reserve engineers a soft landing. I hope consumers somehow work through their debt burdens without a crisis. I hope the economy continues growing and everyone prospers. But hope is not a strategy. I prepare for what I think is likely to happen, not what I hope will happen, and what I think is likely is a consumer credit collapse, starting in 2026 that rivals 2008 in severity. Pay down debt, build savings, secure your income, position defensively. Do not trust that because things are okay today. They will be okay tomorrow. The math does not support complacency. The warning signs are everywhere for those willing to see them. The consumer credit collapse starts in 2026. I have told you what I see. I have explained my reasoning. I have described how to prepare. The rest is up to you.